Okay, guys, we're going to start today's episode a little bit different than what we're used to. We're going to address a question from Stonk on Twitter. He said, Your analysis lines up with mine very closely and very often, many times for different reasons, which makes it even more useful. I understand what that means. He says, You seem to have a solid grasp on macro and treasuries. Can you talk a little about how real interest rates will influence commodities and uranium in the next video? Actually, I'd be happy to because as you may have already noticed, the setup for this video is a little bit different than what you guys are probably used to. The reason for that is we need to take a deeper dive into what's going on in the markets and what's coming next. And we have to dig a lot deeper than just looking at technical analysis on charts, okay? If that's the extent of your knowledge, then you're going to have trouble predicting what comes next. I mean, charts are useful, they're invaluable, actually. But if that's all you're doing, if that's all you're looking at, then you're never going to make it. Okay. This stuff is a lot deeper than that. So, this is actually a great question because it's going to help us transition. It's actually a great segue into the entire video. So, first of all, the answer to your question is more like the capstone, right, on top of a larger structure, right? It's like the smallest block on top of the pyramid. And so, to get to that answer, we kind of got to start at the bottom and build the base up first. So, what are real interest rates? Well, very simply, they're the difference between nominal rates, like the 10-year, right? It's about 2.9%, 3%, and inflation, which is being reported as 8.5%. Now, if you subtract the inflation rate of 8.5% from the nominal yield of 3%, you get a negative 5.5% yield. Okay, so real interest rates are negative. And this is a bit of an historic anomaly. This is not normal for markets. It is not unusual or unprecedented for yields to be low, but for them to be negative is kind of a new paradigm. Now, this has extremely bullish implications for commodities because you have to understand what do real rates imply. Well, it implies that the currency is worthless, right? Like cash is trash. I mean, it's losing value um, faster than it's worth less than it costs. Okay, that's what the real yield implies. It's worth less than it costs. Because consider if you buy that 30-year bond, then you're going to lose money, right? I mean, why would you do that? Especially if you consider that the 2-year treasury has almost the same yield, right? So why would you buy the 30-year when you can just buy the 2-year? But if you're thinking about it like that, then why would you buy the 2-year at all either? Because you're going to lose money on that too, right? It also has a negative real yield, and it's not small, it's significant. Why would you pay to lose money? It doesn't even make sense. So it implies that the debt is worth less than it costs. And this is why bonds are collapsing. This is why the debt market is imploding. And this actually has far greater, more substantial implications than what we've been talking about on the channel so far. This is this is a lot bigger than just finding prices to buy uranium stocks and gold stocks. Okay, this is actually kind of a telltale signal of what's coming in the broader macro sense. To answer your question, it's extremely bullish for commodities because first of all, cash is trash, and so cash is going to sniff out opportunity, right? It's going to look for places where it can grow faster than the rate of inflation. So a good place, obviously, right now is for commodities, especially energy commodities. And there are a lot of variables and factors that are making this true. One of which are artificially induced supply constraints. Okay, we are putting these sanctions on Russia, for example, which are just killing us. I mean, these are nonsensical, stupid, unjustifiable sanctions that are quite literally ruining and are going to ruin people's lives all across the world. I mean, you probably, if you're watching this video, very likely live in the first world. And think about how much it's putting you off. Well, it's not putting you off nearly as much as it's putting people off in some of these other countries. Okay. My best friend moved to Spain is just one example, one anecdotal example. And it has already changed their lives dramatically. I mean, they have to plan when to and when not to use electricity. I mean, this is a big deal, and these sanctions are directly related to that. And if you're supporting these sanctions, you have to understand that you are supporting the deterioration of life, right, around the entire planet. And it's very possible that a lot of people are going to go hungry because of these sanctions, because that we have cut off wheat, We have stopped the planting of wheat. We have cut off fertilizer, right? I mean, Russia is a major exporter of natural gas, and this stuff is coming under artificial supply constraint, and it's going to have serious implications for us. So that's one boon by itself, or the supply constraints, but also fundamentally, commodities are real. And if money costs more than it's worth, then it starts to imply that it's worth nothing, right? I mean, the faith that people have in the currency is going to start deteriorating. And what better place for currency to go than in real goods, right? And that's what commodities are. They come out of the ground, they're of the earth. They have an implied intrinsic value because, first of all, they don't get themselves out of the ground. You got to get them out of the ground, right? And this is often a very tedious, often expensive process, a process that's been getting more expensive, by the way, because costs are going up. What cost? Input costs. Like what? Well, how about fuel? I mean, oil and gas. I mean, most of these things, whether it's uranium or gold or whatever you're mining, you have open pit is the primary way to get a lot of this stuff out of the ground. And these are just bulldozers and dump trucks and, just heavy equipment that are constantly digging, using up all kinds of fuel. I mean, the drivers, that operate these things. I mean, everybody, all these costs have gone up. Okay. And this impacts the bottom line. This is also part of the reason, it's not the primary reason, but it's certainly part of the reason that the value of a lot of the miners haven't gone up as much as you'd expect. It's a minor part, but it is part because their input costs have gone up. Okay, so this hurts the bottom line and this impacts the return, and this should, in a real world, impact the bottom line and the equity share value. Okay, so to an extent, that's a valid reason for them not to have gone up as much. Okay, because these things matter. And looking long term, the narrative is, and you have to understand that the world doesn't run on fact. Okay, this is a critical takeaway that you just need to write down right now. The world doesn't run on fact. The world runs on narrative. And the reason that we start every video with the bond market is because we understand how important this narrative right here is. Okay. And when I've been talking video after video way back here about the market playing chicken with the Fed, what I'm talking about is who's going to win the narrative, okay? Because our prediction is that we would get to this point and things would start to break down. And if you look why it's so important, it's because it's over a 41-year trend that's being threatened to be broken here, okay? And that is a huge deal with massive implications, paradigm shifts taking place, okay? So what you have to understand is that the market fully expected us to come here and turn around like it always has in the past. And our bet was that it wouldn't, that we would get a break, okay? Because the Fed mathematically has no choice. So you ask about what real rates are worth, all right, and how they're going to impact commodities. Well, this has a direct correlation to why we talk about bonds every day. This is why bonds are collapsing. They have to rise until they can find positive real yield. The problem with this is that in order for that to happen, they have to get high enough to meet inflation. Well, we know inflation is being reported at 8.5%. We'll understand fundamentally, mathematically, every 1% raise that you get in interest rates implies a $300 billion increase on our interest obligations on our sovereign debt. Okay, so, and to put that into perspective for you, we only have about $4 trillion worth of tax receipts, right? And like $3 trillion of that gets eaten up right away on liability, or excuse me, not liability, entitlements. So you talk about $300 billion for every 1%, and inflation's being reported at 8.5%. I mean, you're going to eat up all of your tax receipts just to meet inflation. Okay, and that's before you pay for anybody. Right? That's before you pay anybody in government. It's before you build anything. It's for military, but that's before you pay for anything. That's all debt. It's just gone. That money's gone. So obviously this is not sustainable, and it's mathematically not possible, not without a default. So unless you expect the government to willingly, publicly default on their debt and all their obligations, it is all but certain that they're mathematically forced to turn around and start QE number 5. Here's the problem. Here's the nuance that the market missed, is that the world doesn't run on fact. Everybody's betting on that fact, but they miss the nuance. The world doesn't run on fact. It runs on narrative. So what do I mean by that? Well, the narrative is that the Fed's going to be more hawkish than anybody expected. The market has already been pricing in that the Fed was going to turn around and roll over, okay? And this is part of why commodities are being very bullish and the market's kind of still staying up. It's because everybody's counting on the inevitability that the Fed's going to start printing money. And once they do that, then, it's just, all rockets go, right? It's back to the good old days. But the market has recently, the Fed and the IMF have recently come out and straight out told you, they have told you to your face, point blank, that they want equities to fall. They want the market to roll over and correct, right? They want the bubble to deflate, all right? And they do. So what's happening here? Well, the Fed is trying to create the narrative that they're going to be more hawkish than anybody expected. And what they've managed to do is win. Because as the market was playing chicken with the Fed, saying, we don't believe you, we don't believe you, we don't believe you, the Fed doubled down and said, okay, then forget those 50 basis point hikes. We're going to do 75 basis points hikes now. Okay? And they have managed to win over the narrative. And since the market now believes that the Fed is going to hike faster and further than they originally thought, you're seeing the rollover in the markets because now people are afraid. Now people don't know what to expect from the Fed. They don't know how high rates are going to go or how long this is going to last, and it's caused fear and uncertainty. So, of course, everything is selling off because in fear, people run to cash. Okay, when you run to cash, what happens to prices? They fall. What happens when prices fall? You start hitting stop losses, and it just cascades lower and lower and lower. And then people start getting margin called, okay? And then people start getting liquidated. So things over here that might otherwise be totally bullish and worth holding, maybe they don't want to sell those things. Now they have to sell those things because they're getting liquidated over here, right? And this is just how it goes. This is how you knew everything was going to be red on the heat map. This is how you knew just to save cash for this moment. So what happens next is that this is probably going to play out until the next catalyst, okay? So inevitably the market will find the Fed put. But we don't know how long that'll take, and we don't know what necessarily the catalyst will be. There could be unforeseen events that come, new headlines that nobody expected coming that totally turn things around. You can speculate on that, but it's not necessarily worth the time. The only thing you have to know really is that that moment is coming in the future too. Okay, so the inevitability of the turnaround is really baked into the cake. It's just a matter of how long and how far the Fed's willing to drag this out. And that's why there's no need to rush. There's no reason, there's no need to FOMO into any of this stuff because you just have to let it play out, and there's no telling how long it'll take, okay? So as long as the Fed has control of the narrative as being in control and being very hawkish, then we're going lower, okay? And there's a lot further downside that you should expect. It's probably going to go further than you expect. Okay, right about the time you start feeling like, oh my God, this is so low, this is so bad, that's probably about the time it's going to start turning around, right? And we'll be eyeballing this, we'll look for it. But beyond that, there's a lot more to talk about today that I want to get to, okay? We're going to talk about some of the fundamental drivers that make all this stuff happen in the first place, all right? So I'm going to try my best to help you understand these things, and I hope you enjoy it. And please, if this video is helpful at all, just hit the like button and let me know. Feel free to always ask me questions. You can follow me on Twitter. It's a good way to just send me a message. I get those. And it's easier for me to respond on Twitter, obviously, than it is to make a whole video. I mean, this is kind of takes longer than you probably think. But to answer your question, again, in summary, negative real yields are obviously very bullish for commodities because, first of all, as the currency devalues, it's going to try to sniff out opportunities. In the case of uranium specifically, like you asked, uranium is undergoing a bit of a renaissance. It was oversold for a long time as an energy commodity, okay? Energy by itself is very bullish. So let's check mark number one, right? It's coming through, kind of its own renaissance from being oversold a long time, just like oil was. So that's check mark number two. Okay, and it has a lot more upside. It's still technically undervalued from where it needs to be. I mean, even if you listen to guys like Rick Rule, who maybe 6 months or a year ago, we're talking about $60, $70 uranium kind of being the equilibrium. Well, now because of all these higher input costs, now we're talking about $80, $90 being the equilibrium. All right. So we have even further to go now than we did a year ago. So, we're still behind the curve, even to break even. So it has a lot further to go. Well, that sucks. Unfortunately, I had to stop making my video. It's now 6 hours later, but I need to finish this. So I'm going to go ahead and finish it. But unfortunately, I'm going to have to kind of mail it in. So to give you the concepts I was talking about, first is George Soros' theory of reflexivity. This is extremely important to know. It explains a lot of phenomena that happens in markets that a lot of the stuff that people can't explain, and they go looking for answers like, this doesn't make any sense. A lot of it's explained by this theory. And I am no George Soros fan, but I can testify that he is 100% spot on this. Okay, so I would encourage you to really go learn about it and educate yourself on this. Go watch some videos, go check it out. I mean, it states that investors don't base their decisions on reality, and that's true, but rather their perceptions of reality. So first of all, just think about getting into the market, right? If you think the market is rigged, if that's your perception, whether it's true or not doesn't matter. If that's your perception, you're probably not even going to participate in the markets in the first place, right? On the other hand, if you say, hey, they're regulated and all this, and that's a bunch of conspiracy theory talk, they're on the up and up, then you're more likely to participate. But this goes well beyond that. I mean, this explains price justifying behavior. This explains price justifying interest in things. It talks about feedback loops. I mean, it explains the phenomenon that's happening in uranium, because you will take something that's fundamentally legitimate, like uranium is, but it's going to, the best way to describe it is inflation and people hoarding. Okay, so people go hoard, right? And so in anticipation of higher toilet paper prices, they go ahead and they go buy 2 or 3 times more toilet paper than they actually need, so that they pay a lower price today in anticipation of higher prices in the future. But all that really does is restrain supply today, and in doing so, you force higher prices in the future, right? So it's kind of a self-fulfilling prophecy, where inflation begets and more inflation, right? So the perception of people's behavior causes fundamental supply chain reality. All right. So even if it's not based in reality, it can cause reality. Okay. And it can impact reality. And so you really need to educate yourself on this. Another concept of reflexivity is that you can take broad general truths out in the world, kind of universal laws, and you can apply them to the markets. And this is true. Now, if you've never seen my first episode of the Liberty Offensive, I would really encourage you to go watch it. It's about liberty and why we're losing our liberties and all this kind of stuff. And I talk about the Ash principle, the Ash experiment, and the Hope experiment. And these have to do with conformity and being strung along and given false hope, and how this changes people's behavior. And even though these don't directly have anything to do with markets, they do apply to markets, right? And just like the Pareto Principle applies to markets too. And so, for example, the sell-off we've had in the last few days, I mean, you can guarantee that 80% of the selling came from 20% of the market participants. All right, a lot of these people just came in late and didn't even have a clue what was going on until late in the day, right? But you can extrapolate this into a lot of things. I mean, I use it at work all the time. I mean, I manage a lot of people, and I do it using 80-20, right? So I do it on the philosophy that as long as I mainstream the business and keep things running smoothly, then 80% of the processes we have to do at work kind of run on autopilot, right? As long as I'm doing my job right, I don't have anything to do 80% of the time, right? But you can't get rid of me even though I put those systems in place, because 20% of the time I'm needed, I deliver, right? It's because it's 20% of the time when those massive unexpected events happen that you have to manage, okay? And those have to be managed well, because even though they're only 20% of the occasion, they're 80% of your losses, right? So the 80-20 rule always works. This works in markets. This works in pretty much everything. I mean, people always complain about a few people owning all of the wealth, right? And this has been true since the beginning of time, actually. I mean, it's just an ongoing principle. It's the Pareto Principle. I mean, even Jesus talked about the Pareto Principle, right? Remember what he said? He said, to he who has, more will be given, and to he who lacks, even that will be taken away from him. Okay, so this is as old as time. And if you want to know more about it, I would actually recommend you listening to Jordan Peterson when he was on Joe Rogan, not the most recent time, but before that. And he talked about Joe Rogan's rise to fame and how, success begets success and how it kind of snowballs on itself. And then once you're in the top, you're kind of there. Um, there's a lot to learn from this, and you can apply this to the markets too. Unfortunately, I'm pressed for time, so we'll have to come back on examples for this in the future. But the last and final principle I wanted to introduce you to today was Wyckoff. Okay, so Wyckoff realized that regular everyday traders were getting fleeced. Right? He recognized that institutional money was setting people up to be sold on. All right, and this is why I talked about Wyckoff happening in uranium. You remember that when I set this up? Well, in retrospect, I got that exactly right. I was just early because I thought that this was the fifth shoulder, and we came up, and this is indeed the fifth shoulder. This was Wyckoff. This was distribution. You remember back here when I was talking about these candles? Every time we came up to this level on anything, we kept getting distribution, right? It didn't like going up, but it was going anyway. That's because all of the big money was selling. So you had retail coming in, buying all this stuff up, right? Like all the hype in the world you get on Twitter. I mean, you need to buy. All the people you pay for newsletters and stuff were telling you to buy, and the institutions were dumping on you. Okay, so this setup was clear. In retrospect, we did get it right. But nonetheless, in retrospect, that's what it was, and that's why I want you to understand what it is. That way you can spot it when it happens, okay? So this is a little bit more complicated. I promise to come back and touch on this again in the future to help explain it better. But between the theory of reflexivity, the Pareto Principle, and the Wyckoff, this will help you step your game up, all right? This will help you level up, not only as a trader, but just kind of in general as a person too. This kind of helps unlock your mind. This kind of helps you see the code in the matrix, right? Does that make sense? It's kind of like a red pill in the markets. And once you understand these things, it helps you to foresee things. It helps you to recognize what's happening when it's happening, right? Technical analysis is good, but as a trader, as an investor, you need more than that, right? This is just kind of like milk, all right? You start getting in this is more like the meat and potatoes of things, right? This is kind of a level up. And that's part of why I made this channel, was to help introduce things like this for you. But unfortunately, like I said, I'm coming back. It's nighttime. Everybody's going to sleep here. I'm just trying to get this done for you guys to have something published. But we'll come back and revisit. But I would encourage you to kind of go do homework and educate yourself on these things. So with that being said, what can we look forward to in the markets this week? Well, I've been looking for patterns and trends in the past, and the best one for sure is in Cameco. All right, if you go back to the last bull run through the 2000s, let me put this on the weekly. Quite clearly, I made this a long time ago. It's not as clean, but it gets the job done. So out of all of the uptrends, they averaged 10 months in length, okay? So you had 10 months of just uptrend before a major pivot turn. Each uptrend averaged 167% of gains, okay? Consequently, each downturn averaged about 4 months, okay? And each of those downtrends averaged about 33% in losses, all right? Well, how does that compare to today? Well, actually, it's very interesting because the sell-offs are quite similar. The average length right now is 3.6 months, and the average downtrend loss is 30.8%. So if you extrapolate that out and get the average, you could expect a projected price in Cameco between $22.50 and $24 by the end of July. Okay? And I think that that's exactly what you need to be looking for. All right? You know, this just started. It's not going to bounce here. Okay? We have more downside to go, and you just need to accept that. Now, if you have zero exposure and you're looking to get in, right, it's a little bit different. You know, you can spend some cash because obviously anything could happen. It could turn around, but the odds, the probability is that we're going down further. So you need to save the bulk of your cash for these lower bound levels. Okay, that's what the patience is all about. That's why you've saved cash in the first place, right? Don't spend it here if we think you can get it spent right here. All right. So my advice to everyone is just to be as patient as possible. All right, because we will very likely hit these lower levels. You'll probably have days where it gets a bounce, and it's like, oh, it's turning around. and it's just going to roll back down. You're going to get oversold bounces and stuff. But if you take a look, I mean, we're clearly going to the 200 on the daily, just like I talked about. I've been predicting that for how long now? Okay. And then the 50 on the weekly. I mean, that's just where you want to buy. That's simply where you want to buy. I am working on lower levels if we break, right? If we break out of these ascending channels, I'm working on buy levels for that, okay? And the first one I have on a lower bound, I don't think we break out on energy fuels, but I've already worked out the first lower bound, and that will be $6.08. There's a lot of confluence here. I mean, check this out. Energy fuels doesn't like to come down and test the 200 on the weekly, all right? It kind of rides at 50, but it does stay within about 27%, all right? Right about 25%, 26% puts you at this line, which is strong support. I think that that's the kind of pattern we're looking for major lows, all right? So you can spend 50% kind of at this level, save the rest for down here, all right? I think this is going to go lower than people expect. I think, this is going to shake out for a bit, guys. So just be patient. That's all I'm asking. I'm begging you to be patient. It's also really encouraging to see the confluence still in commodities broadly. So if you look at silver, it looks very similar to the setup in uranium in terms of being near that first major support, okay? First major big leg on a weekly time frame, all right? And then you would have another major low a bit below that, all right? So you can extrapolate this and kind of look for confluence across the entire space because they all kind of look the same. All right, so just be kind of checking everything out across the board, and that's how we're going to find the bottom at the same time.